Investing is a crucial part of personal finance, one that allows individuals to grow their wealth over time. Two primary vehicles for investment are stocks and bonds, the basics of which are essential to understand for any prospective investor. Stocks represent ownership in a company. When you buy stocks, also known as shares or equities, you're buying a piece of the company's assets and earnings. Companies issue stocks to raise capital for various reasons, such as expanding their business or paying off debt. Stocks are traded on exchanges, such as the New York Stock Exchange, NYSE, or the Nasdaq, where the price fluctuates based on supply and demand dynamics. The value of stocks can rise or fall dramatically, depending on several factors, such as the company's performance, general economic conditions, or market sentiment. As a shareholder, you stand to gain if the stock price increases because you can sell your shares at a higher price. Alternatively, if the company does well, it may distribute a part of its profits as dividends to its shareholders. However, the risk in stock investing lies in the potential of losing your investment if the company underperforms or the stock price declines. On the other hand, bonds are essentially loans that investors make to entities, typically corporations or governments. When you buy a bond, you are lending your money to the issuer for a specific period, known as the bond's maturity. In return, the issuer promises to pay you a predetermined rate of interest at regular intervals and repay the principal amount at maturity. Unlike stocks, bonds do not give you ownership in the company or government issuing them. Bonds are considered less risky than stocks because the interest payments and the return of principal at maturity are contractually guaranteed by the issuer. However, bonds are not entirely risk-free. The main risks include credit risk, which is the risk that the issuer may default on their payment obligations, and interest rate risk, where the value of bonds can fall if interest rates rise. Hello everyone, and welcome back to our channel, where we bring you insights into the world of investing. In today's episode, we're delving into some truly fundamental concepts that every investor must grapple with. We're talking about understanding risk and reward, the importance of diversification, the power of compound interest, and the often overlooked impact of inflation on investments. Whether you're a seasoned investor or just starting your journey in the financial markets, understanding these concepts is pivotal to making informed decisions and ensuring sustainable financial growth. Let's dive in. First fact: the relationship between stocks and bonds is another important facet to understand. They often have an inverse relationship. When stock prices fall, bond prices tend to rise, and vice versa. This is because when the economy is doing well, investors tend to buy stocks to benefit from company growth, driving stock prices up and bond prices down. Conversely, during economic downturns, investors flock to the relative safety of bonds, pushing their prices up. Therefore, a balanced investment portfolio often includes both stocks and bonds. The proportion depends on individual risk tolerance, investment goals, and time horizon. A young investor with a high risk tolerance might hold a higher percentage of stocks for potential growth. In contrast, a retiree seeking a steady income might hold more bonds. In conclusion, understanding the basics of stocks and bonds is fundamental to effective investing. Stocks offer potential for higher returns but come with greater risk, while bonds provide more stable, albeit typically lower, returns. Both are essential tools in the arsenal of any serious investor, and a balanced mix of both can help mitigate risk while still providing growth opportunities. Second fact: risk and reward are two fundamental concepts in the world of investing. They form a delicate balance that every investor must navigate to ensure the growth and preservation of their capital. Understanding these twin elements of investing, risk, and reward, is crucial for any investor looking to make informed and effective decisions about where to allocate their resources. Risk, in the simplest of terms, refers to the possibility of an investor losing some or all of their original investment. It's an inherent aspect of investing and can never be eliminated. However, it can be managed and mitigated through strategies like diversification, or spreading investments across different types of assets, asset allocation, or deciding what percentage of your portfolio to dedicate to various asset classes like stocks, bonds, or real estate. There are several types of risk that investors should be aware of. Market risk, also known as systematic risk, is associated with the entire market and affects all investments. Economic events, such as a recession, can lead to declines in various asset classes simultaneously. Unsystematic risk, on the other hand, is unique to a specific company or industry. For example, a technology company might suffer a setback due to a security breach, leading to a decline in its stock price. Other types of risk include inflation risk, interest rate risk, and liquidity risk, among others. Reward, on the other hand, is the potential financial return an investor receives on their investment. It's the reason individuals and institutions decide to invest their money in the first place. The reward could be in the form of capital gains, where the value of an investment increases over time, or income, such as dividends from stocks or interest from bonds. Understanding the relationship between risk and reward is paramount. The risk-reward trade-off is a central tenet of investing. Higher potential returns come with higher risk, and lower risk typically means lower potential returns. For example, stocks have historically provided higher returns than bonds over the long term but at a greater level of risk. A tech startup might offer the potential for massive returns, but it also carries a high risk of failure. It's important to note that the concept of reward should always be considered in the context of risk. For instance, an investment that returned 15% might seem superior to one that returned 10%. However, if the 15% return came with significantly higher risk, the 10% return might be the better option when considering the risk-adjusted return. Every investor has a unique risk tolerance, which depends on factors like financial goals, investment horizon, and personal comfort with potential losses. Understanding one's risk tolerance is key in crafting an investment strategy that aligns with their financial goals while not causing undue stress. In summary, understanding risk and reward is essential in the investing journey. While risk involves the chance of losing money, reward represents the potential financial gain. A careful balance between these two is crucial, guided by the investor's risk tolerance and financial goals. Mastering the dance between risk and reward is what distinguishes successful investors and allows them to achieve their financial objectives while preserving their peace of mind. Third fact: diversification is a key concept in the investment world, serving as a central pillar of effective portfolio management. It is the practice of spreading investments among a variety of different financial instruments, sectors, and geographic areas to reduce risk. The core rationale behind diversification is that a variety of investments will, on average, yield higher returns and pose a lower risk than any individual investment within the portfolio. The key to understanding diversification lies in a fundamental financial principle: the negative correlation of asset prices. Simply put, not all assets move in the same direction at the same time. Some might increase in value while others decrease. By investing in a diverse array of assets, you're likely to reduce the impact if one of your investments suffers a loss. This is because other investments in your portfolio, uncorrelated or negatively correlated with the losing asset, may perform well and offset the losses. Consider the implications of investing in a single stock versus investing in a broad stock market index fund. In the first scenario, your entire investment is tied to the performance of a single company. If that company's stock plummets, your entire investment takes a significant hit. However, if you invest in an index fund that represents hundreds or thousands of different stocks, a drop in any single stock's value has a far smaller effect on your overall investment. Diversification is not limited to asset types or sectors but can also be applied to geographic locations. For example, if all of your investments are in U.S. stocks, you're entirely exposed to the performance of the U.S. economy. But by also investing in European, Asian, or other emerging market stocks, you're diversifying your exposure and decreasing the impact of any one regional downturn. It's important to note, however, that diversification is not a guarantee against loss. During significant market downturns, such as the 2008 financial crisis, almost all assets can depreciate simultaneously. Nevertheless, diversification can help smooth out returns over time and reduce the potential for significant losses. That said, diversification should not be a random process of selecting different investments. A properly diversified portfolio is carefully constructed with investments that align with the investor's goals, risk tolerance, and investment horizon. It requires ongoing maintenance, as market conditions and personal circumstances can change over time, necessitating adjustments to the asset allocation. Moreover, diversification extends beyond merely investing in different stocks or bonds. It also involves diversifying across different asset classes, such as real estate, commodities, or even alternative investments like cryptocurrencies or private equity. In conclusion, diversification is an essential strategy in investment management. It reduces the risk associated with investing by spreading investments across a variety of different assets, sectors, and regions. A well-diversified portfolio can offer the potential for stable growth, cushioning the blow from losses in any single investment. But it's crucial to remember that diversification is an art as much as a science, and the right mix of investments will vary depending on each investor's specific circumstances and goals. Thus, understanding the importance of diversification is the first step toward building a resilient and effective investment portfolio. Fourth fact: compound interest is one of the most powerful concepts in finance, famously referred to as the eighth wonder of the world by Albert Einstein due to its ability to exponentially increase the value of an investment over time. Understanding the impact of compound interest is pivotal for everyone, from young individuals just starting their financial journey to experienced investors looking to maximize their returns. Compound interest works on the principle of accumulating interest on the initial principal and the interest already added to that principal. Simply put, it's interest on interest. This contrasts with simple interest, where interest is calculated only on the initial principal. The difference might seem trivial at first, but over long periods, compound interest can have a significant impact on the growth of an investment or debt. Consider this example. If you invest $1,000 at an annual interest rate of 5%, after 1 year, you will earn $50 in simple interest. In the second year, with simple interest, you would earn another $50. However, with compound interest, in the second year, you would earn interest not only on the original $1,000 but also on the $50 in interest from the first year, yielding $52.50. While the difference might seem small at first, it magnifies over time, especially when dealing with larger amounts of money and longer time frames. The frequency of compounding can significantly affect the total amount of interest earned. Interest can be compounded on various schedules: annually, semi-annually, quarterly, monthly, or even daily. The more frequently interest is compounded, the greater the overall returns. Thus, when comparing different investment opportunities, it's important to consider not only the interest rate but also the compounding frequency. Compound interest plays a crucial role in investing. It's the driving force behind the concept of the time value of money, which holds that money available today is worth more than the same amount in the future due to its potential earning capacity. This principle highlights the importance of starting to invest early and allowing compound interest to work over time. Even relatively small investments can grow significantly over long periods due to the power of compounding. However, it's also essential to understand that compound interest can work against you. In the context of loans and debts, compound interest can cause the amount owed to grow exponentially, making it harder to pay off the debt over time. In conclusion, the impact of compound interest is profound and multifaceted. In the positive sense, it provides the foundation for the growth of savings and investment, underlining the importance of starting early and being patient. Conversely, it also explains how debt can spiral out of control if not managed properly. Thus, a solid understanding of compound interest is critical to making wise financial decisions. It's a tool that, depending on how it's used, can be a powerful ally or a formidable adversary in one's financial journey. As a result, recognizing the impact of compound interest can significantly influence a person's financial health and wealth accumulation efforts. Fifth fact: inflation is a ubiquitous phenomenon in any economy, subtly eroding the purchasing power of money over time. It refers to the general increase in prices and falls in the purchasing value of money. For investors, understanding the effect of inflation on investments is crucial, as it plays a significant role in determining the real rate of return on investment. When we talk about returns on investment, there are two types: nominal and real. The nominal return is the gain an investor receives from the investment without taking into account the impact of inflation. The real return, however, is the return after inflation has been factored in. It reflects the actual purchasing power that the returns or the investment will command in the future. Let's consider an example. If an investment yields a 6% annual return and the inflation rate is 2%, the real return on that investment is approximately 4%. The difference might seem small at first, but over time, inflation can significantly erode the value of the returns and the principal invested. For bondholders, inflation is often viewed as a menace. Fixed income securities like bonds pay a fixed interest rate over a certain period. If inflation rises and surpasses the interest rate earned on the bond, the real return for the bondholder could be negative. The purchasing power of the periodic interest payments and the principal to be received in the future would fall, reducing the bond's attractiveness. Similarly, savers are also disadvantaged by inflation. Money saved today and kept idle will lose value over time as inflation reduces its purchasing power. For example, with an average annual inflation rate of 2%, $1,000 saved today would be worth approximately $820 in purchasing power after 10 years. On the other hand, inflation can have varying impacts on equities. Stocks represent shares in businesses, and businesses often can pass increased costs due to inflation onto their customers in the form of higher prices. Therefore, in periods of moderate inflation, companies may still maintain their profitability, which may be reflected in their stock prices. However, high levels of inflation can increase costs too quickly or decrease demand too drastically, hampering corporate profitability and potentially leading to declining stock prices. Real assets like real estate and commodities can sometimes provide a hedge against inflation. As prices rise, the value of real assets tends to rise too, maintaining the purchasing power of the money invested in them. In conclusion, inflation can significantly impact various types of investments, sometimes positively, but more often negatively. It erodes the value of money over time, affecting both the returns on investments and the principal invested. While certain types of assets can provide a hedge against inflation, understanding and accounting for inflation's effect is crucial for all investors. It emphasizes the need for investments to not only generate positive nominal returns but also keep pace with or exceed inflation to increase real wealth over time. By factoring in inflation, investors can make more informed decisions and choose investment strategies that protect their purchasing power. And that wraps up today's in-depth exploration of these key investment concepts. We've unpacked the balancing act between risk and reward, illuminated the power of diversification in managing investment risk, demystified the compounding effect of interest, and shed light on how inflation affects your investments. Remember, investing is not just about making money, it's about understanding how money works. Armed with this knowledge, you can navigate the financial landscape with increased confidence and effectiveness. If you found value in this video, please like, share, and subscribe to our channel for more insightful content on investing. As always, we appreciate your engagement and encourage you to leave any questions or thoughts in the comments section below. Thank you for joining us today, and until next time, remember, your investment journey is a marathon, not a sprint. Stay informed, stay diversified, and let the power of compound interest and understanding of inflation work in your favor. Happy investing.